So how did you fund the company when you started out?
So it's funny because the other two companies that we did before were both venture funded.
Right.
So we had raised venture money. We're here in Silicon Valley. So it's kind of the standard mental path as you go and you raise venture funding.
Mm-hmm.
When we started Backblaze, we said, should we do that again? And there are pros and cons of venture funding. And we said, no, let's do this one differently. And so what we actually did was the five of us committed to each other for 1 year with no salary. We would put a little bit of money in and we would bootstrap the company for 1 year to do that. And we said, we wanted to do that because we said, by doing that, we could just focus on customers. We could focus on product. We could focus on culture. We said no pitch decks, no pitching, no presentation, no PowerPoints. That we're just going to focus on the customers, the product, and the culture. And a year became a year and a half. We went with no salary, and then we ended up taking about a minimum wage for about a year, and then we took 2 times minimum wage for about 2 years. So it was a long slog where we did not pay ourselves for the most part. But we basically almost entirely bootstrapped for 15 years. We did raise about $2.5 million into the company 5 years in. But up until we took the company public in about 2 years ago, we'd raised less than $3 million into the company up until just before the IPO. And then we took the company public on the Nasdaq in 2021.
This is always interesting when you're bootstrapping versus taking venture capital. Is, how did you manage the growth of your staff?
Very, very lean.
Yeah.
Right. So in the venture funded companies that we did before, you would immediately start by let's hire a bunch of people.
Yeah, right.
So in the first company that we did, we raised money and we hired about 40 people in the span of 9 months.
That's a lot.
At Backblaze, it was very much a process of first you generate find the customers, then they pay you. Then when you have enough customers paying you enough money that you can have enough cash flow, then you hire a person. And so that's what we did in this case. We staffed up very, very carefully.
Yeah.
A lot of it also obviously was the original 5 founders plus 2 what we call demi-founders who joined later and went without salary for a shorter period of time and put less money in, but some, by virtue of us all taking very deferred salaries for a long time, that helped fund the company. But then there were a number of other things that we did just in terms of spending very little and bringing cash in. So one of the things that we did to bring cash in was we charged customers from day one. So a lot of times you might say, well, don't charge customers until some later portion. We said, look, we're going to provide customers a service. And one of the things we want to see is if customers are willing to pay for it. So we charged customers when we had a beta. We also sold monthly, annual, and 2-year plans. And by getting some of the annual and 2-year plans, that brought cash in earlier. So there was things that we did to bring in cash earlier, and there was a lot of things that we did to spend less.
So, 2 venture-backed companies and 1 bootstrap company, if you kind of look at that, and if you can do so in a non-attached way, an unattached way, or an unemotional way, what would you say the pros and cons were for both methods?
Yeah, I mean, there's definitely pros and cons.
Yeah.
And so the pros on the side of venture funding were we had a bunch of cash up front that we could spend on things. We could take salaries.
Yep.
We had more cash in the bank that provided a buffer in case of something didn't go right. We could choose to invest in things. Raising cash is something that is celebrated in Silicon Valley. So you get kudos for that. You get press for that. You get credibility from raising cash. By the way, those parts of things I think are not necessarily correct, but that is what happens. So those are some of the pros,
right?
That from the venture side. On the bootstrapping side, I think one of the big things that you get is you build a culture of people who care and treat dollars as their own.
Yeah.
And it's really hard to do with when you venture from the get-go, because if on day one, the founding team is spending a lot of time focusing on investors and how to get money from investors, they're not spending as much time on how to get money from customers. And that then is what the other team members see. Right. So in our case, we cared a lot about every customer paying us $5, and that mattered. And everyone that worked with us could see that we cared about those customers and solving their problems. And so it created this culture where people really treated dollars like their own. And that's really hard to build in a company where you venture funded from the beginning. Other things that are beneficial about the bootstrapping, you don't give away as much equity.
That's right.
So both for the founders and also for the employees, they get to keep more of the company.
Yep.
There's also a more time that you get to spend on the company, not on managing investors and outside people.
Yeah.
So that's another bootstrapping benefit.
Mm-hmm.
And the other is just kind of alignment, right? So investors are somewhat aligned with the founders in that you're all trying to build this company and asset. But especially in an early stage company, there's a lot of potential pivoting that's going on as you're trying to find the path.
Right.
And if you've sold investors on one vision and you're pivoting and trying to figure it out, sometimes it's hard to get them aligned.
Mm-hmm.
And we had this at a prior company where we had started as a consumer company, ended up finding that the demand for the offering was much more in the enterprise, but we had brought on an investor who was only interested in consumer businesses. And so that created some tension and challenges in the past.
Right.
So those are some of the pros and cons, I think, of bootstrapping versus venture investment.
And what you said is nothing that surprises me, but I think for people listening to this, it's really important to hear this, right?
I think actually just one thing on that is that especially in Silicon Valley, and especially because there's the very common thing of, every time someone gets venture funding, you get an article in TechCrunch about it, right? It's people start to believe that it's the only path, right? Before they even necessarily have an idea, they start thinking, how am I going to raise funding?
Right.
And really, funding should be thought of as a means to an end. And some companies, you need the venture funding. It would be hard to build. Uber would have probably been hard to build without venture funding. But there are lots and lots of companies that don't need venture funding to get started, mm-hmm. and can go pretty far without it. And there's a lot of benefits to doing
mm-hmm.
that first.
Carol Schultz here. Thanks for watching this excerpt from Authentically Successful. The conversation doesn't end there. So if you want to hear this episode in full and all my conversations with many other successful founders and CEOs, please visit verticalelevation.com/podcast.